Hi everyone, welcome back to our channel where we talk about all things money and personal finance. Today we're going to talk about one of the most important financial goals that we should all have, and that is saving for retirement. Retirement may seem like a long way off, but it is never too early to start planning for it. In this video, we will cover some tips and strategies on how you can start saving for retirement today. Firstly, it is important to understand the power of compound interest. Compound interest is the interest earned on both the principal amount and the accumulated interest. Over time, this can add up to a significant amount. The earlier you start saving, the more time your money has to grow through compound interest. Therefore, it is important to start saving early and consistently. It is important to understand that the earlier you start saving, the more time your money has to grow through compound interest. Therefore, it is important to start saving early and consistently. If you wait too long or stop saving altogether, it will be harder for your money to grow over time due to inflation eroding its value. The next step is to figure out how much money you will need in retirement. This can be a difficult question to answer as it depends on a number of factors such as your lifestyle, anticipated expenses, and how long you expect to live. However, a good rule of thumb is to save 10 to 15% of your income for retirement. If you are in your 20s, you should aim to save at least 10% of your income. If you are in your 30s, it is recommended that you save 15 to 20%. And if you are in your 40s or 50s, then it is recommended that you try to save at least 20 to 25% of your income. Once again, the earlier and more consistently you start saving for retirement, the better off you will be when the time comes. Once you have an idea of how much you need to save, the next step is to determine how you will save. There are many different retirement accounts available, and each has its own benefits and limitations. Some of the most common retirement accounts include 401k. This is a retirement account offered by many employers. You can contribute up to $19,500 per year, and your employer may also contribute to your account. With a 401k, you will typically have a few investment choices. The most common are target date funds, which include a mix of stocks and bonds that become more conservative as you approach retirement age. You can also choose to invest in individual stocks or mutual funds. Individual retirement accounts. There are two types of IRAs, traditional and Roth. With a traditional IRA, you can contribute up to $6,000 per year, and your contributions may be tax deductible. With a Roth IRA, you can contribute up to $6,000 per year, but your contributions are not tax deductible. With both types of IRAs, your money grows tax deferred until you withdraw it. If you contribute to a traditional IRA, you can withdraw your contributions but not earnings at any time without penalty. Withdrawals before age 59 and a half may be subject to an additional 10% penalty. If you contribute to a Roth IRA, you cannot take money out of it without penalties before age 59 and a half, unless there is an exception, such as a disability or death. Simplified Employee Pension. This is a retirement plan for self-employed individuals or small business owners. You can contribute up to 25% of your income or $50,000 per year, whichever is less. Additional rules apply. You must be a sole proprietor, have no employees other than your spouse, and use the calendar year as your tax year. The SEP is funded by contributions directly from your business. Simple IRA. This is a retirement plan for small businesses with fewer than 100 employees. You can contribute up to $13,500 per year, and your employer may also contribute to your account. The contributions are tax deductible, and you can take a tax deduction for any contributions your employer makes. The plan has no vesting schedule and is portable when you change jobs. It is important to research each of these accounts and determine which one is right for you based on your income, tax situation, and retirement goals. Another important factor to consider when saving for retirement is asset allocation. Asset allocation refers to the percentage of your retirement savings that you invest in different types of assets, such as stocks, bonds, and cash. The goal of asset allocation is to achieve a balance between risk and return. Generally, the younger you are, the more risk you can take on because you have more time to recover from any losses. As you get closer to retirement, it is important to shift your investment towards more conservative options to protect your savings. If you are saving for retirement, it is important to take into account your tax situation as well as your investment goals. For example, if you are in a high tax bracket now, but expect to be in a lower one once you retire, it may be best to invest in tax-exempt bonds instead of taxable ones. Alternatively, if you plan on spending the money from your retirement accounts during your lifetime and do not want them taxed when withdrawn. Lastly, it is important to review and adjust your retirement plan regularly. Life is unpredictable, and your retirement plan may need to change over time. For example, if you have a major life event such as a divorce or the birth of a child, you may need to adjust your savings goals. Additionally, changes in the economy or stock market may require you to adjust your asset allocation. As you can see, there are many factors to consider when creating a retirement plan. If you are able to carefully consider these factors and create a comprehensive retirement plan, you will be better prepared for your future. In conclusion, saving for retirement is a crucial financial goal that everyone should be working towards. Starting early, understanding the power of compound interest, choosing the right retirement account, and regularly reviewing and adjusting your retirement plan can help you achieve a comfortable retirement. Thank you for watching, and don't forget to subscribe to our channel for more personal finance tips and advice, and always make sure to consult with a financial expert.